Hello and welcome to episode 180 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leeks. Damien, now straight away, right at the start of the show, I believe I actually referenced last week's show as number 139. Somehow we lost 40 episodes and we went back in time. I do apologise. Neither of us noticed it though.
No, we didn't, and people might find this strange, but I do often listen back to the show and I laugh at my own jokes, even if they're not funny the first time out. And so I didn't listen to last week's show, so I did miss that, Andy. But there we go. Yeah, We're only human.
I was editing away and I was thinking to myself, I just said 139 there. I meant 179. So I hope we didn't lose any listeners or people who tuned in last week thought, no, that's an old one and then skipped it. If you're one of those people this week that thought last week was an old one, go back and listen to it. It was a new one. I was just being an idiot. Anyway, Damien, how are we doing? You had a good week?
I have had a good week, actually, Andy. It's been productive, busy, the same old on the Money to the Masses front. We're doing a lot of work behind the scenes, as I've said before. So I've been doing a lot of that stuff, a lot of stuff with journalists, wanting comments and bits and pieces. So that's all good. So yeah, I've had an epic week in terms of work, and I mentioned to you off podcast just to give people an insight into my world. For a lot of people, Friday the 13th is a scary day. Now for me, Friday the 1st is a scary day, and it's because it's the perfect storm of when lots of content in terms of 80/20 investor, newsletters, all these things that happen at the start of the month align with things that should happen at the end of a week, and it just means that my Friday is the day from hell, which seems a bit odd to have created an entity where Friday is your worst day of the week. But conversely, Monday is is probably my favourite day of the week because it is my easiest day. But anyway, Andy, how was your week?
My week's been absolutely fine, to be honest. Yeah, just been getting on with it. Very, very busy this week. I'm on holiday next week. Don't worry, there will be a podcast. I'm only away for a few days, but been working and busy in a way, trying to make sure I get everything done before I go away, as you do. And I've also joined a gym. So there we go. You told me about the benefits of joining a gym a few months back, and I finally jumped on that bandwagon. And who knows, in about 3 weeks' time, I'll be paying, I don't know, £60-80 a month for something I never use again, and I'll be regretting it ever since. Well, so, looking forward to that.
You could be worse. You could be like my brother Justin, who people may have seen on any videos or whatever we've done. He once, I was in a class with him about a month ago, and he pulled his buttock in the middle of the gym. He tried to style it out, but he pulled the muscle in his bum, and in the middle of a class had to stop and try and hobble off when the instructor said what happened. He had to tell him he'd hurt his bum, which was, I don't know, that just tickled me in a very juvenile way. And the next class I went to, because he goes to the same gym as me, the gym instructor just came up to me and asked him how his bottom was and how he's been, in a very serious and concerned way for somebody who's had an injury in his class. But it just made me laugh. So it was I think he was quite embarrassed by the whole incident. It was a bit like me and my back when I pulled it in a class of mums when I was apparently showing off. Everybody else says I wasn't, but rather my back than my bottom. And I didn't even know he had any muscles in his bottom, but there we go. While we're on the subject of this week, I want to talk about 2 reviews we've had. With some more reviews. We keep encouraging people, please leave a review because we'll likely read them out. Now, someone called Banksy left a review on Monday saying it's informative and fun. I'm assuming he's referring to our podcast rather than graffitiing Bristol. Learned loads from this podcast, and Damien and Andy managed to do it in a fun and relaxed way, really useful and easy listening. And then that was followed by Matthew C. the next day, interesting and informative. It's nice to hear an unbiased and well presented podcast on personal finance. I think that's a reference to you, Andy. I've recently started to get my finances in order and am now in a position to invest for the future, and this podcast has come very much in handy. So much so, I've signed up to 80/20 Investor. Finance can be a very dry topic, but Damien and Andy present the content in an informative and topical way. Well done. So there we go, Andy. Send in your reviews. Right.
Good stuff. So what have we got coming up on this week's pod?
Three pieces as usual. I will veer off onto another piece about exit fees, touching on something we did last week. Just an FYI, really. But you're going to love Scam Watch. We've got something on scams. I know you love a scam, Andy.
I do love a scam. I can't get away from it. I even watch these awful programs on TV where people, don't get done, get dom, and all that kind of rubbish that's on the telly. I love it. I'll watch repeats that are on Dave and UK TV and all this nonsense. Anyway,
we should have a section, Andy's Scams. It's a bit like the children's program, Andy's Dinosaur Adventures. It'll be Andy's Scams.
Yeah, but it sounds like I'm the one who's sort of, doing these scams.
Well, it could be. I've got a piece on investing to do with consistent funds. Now, this is a bit of a... I'm teaching people how to do it. It's a kind of... think of it as a Blue Peter or Jamie Oliver showing you how to cook something. I'm telling you how I did it. How I did a research piece for 80/20 Investor that was based around finding consistently performing funds. So funds that have done well over a period of time. And the final piece is just on energy bills. There's something about dual fuel bills. Now, we all know that having your fuel, your gas and electricity with the same provider can save you money. Well, it turns out that isn't likely to be true. So I'm going to explain why.
Good. So what are we going to start with?
Let's do scams, Andy, because I know you're busting for a scam. Before that, I just want to touch on the exit fee piece I said about last week. Now, we talked about exit fees and that some companies charged them when people didn't realise and to watch out for. Now, Ofcom must have been hearing us because they had a pop at Virgin Media. So it's another one out there to be aware of, because Virgin Media apparently have been charging people up to £240 to get out of their contracts. And Ofcom, which are the telecoms regulator, were worried that they'd breached the consumer protection rules in doing so. And when they looked at it, they felt that the harsh exit penalties contravened the general condition, which is not to charge excessive fees to disincentivise people from switching. And that's the official terminology. So what they're doing is they're investigating them and they're looking closely into it. Now, they are also investigating EE. And if you don't know what EE were doing with their family and friends offers, listen to last week's podcast. So there is movement in this world of exit fees with the various regulators trying to do something. So let's hope others follow course. Right, scams. Now, Andy, did you watch the royal wedding the other week?
I caught some of it on a mobile device while having a picnic in a field. Basically, to keep
up a
things
tree with
nice
an
and
owl.
simple.
Yeah.
The compromise was my wife was interested in watching it. I wasn't. I wanted to take advantage of the fact that everyone else will be watching it, so why don't we go and do something where it's going to be really quiet? And it was a really nice day. I don't know if you remember, it was a really sunny day. So our compromise was we'll go for a picnic in a field, just a family, the four of us, but we'll take a device with us and she can watch it on the phone kind of thing. So that's what we did. We watched the royal wedding in a field, just the four of us. It was really nice, actually. It was interesting. Probably too much information, but that's what we did.
I think it's brilliant. This seems a bit surreal. I'm not going to watch the royal wedding like everybody else. I'm going to go and sit in a field and do it. Brilliant, Andy.
Such a ludder, aren't I? Just wanting to get away from everything. Although we did use technology.
Yeah.
So there we go.
Sorry, you just knocked me off course. You knocked me off course there. Now, the reason I mentioned the royal wedding was the something has been doing the rounds on social media about the royal wedding, and it's after the event. So the meme or picture that was going around is, what is your royal guest name? So if you'd been invited to the royal wedding, what would be your name? And the aim of this piece was you had to do you've probably seen them on Facebook or whatever, when they normally talk about, I know, your porn star name or something like that, and you use combinations of things from your past and all this kind of stuff. So this particular one, Andy, was a bit like that. You had to give yourself a title, so you'd be Lord or Lady based on your gender. You take your grandparents' name as your first name. You would take your surname would be the name of your first pet, and then you would be whatever that grand name was of, where you'd obviously say where you were from, as they would with a royal title, and you'd use your street name. Now that all seems very inoffensive. and a bit of fun, until you point out the fact that each of those pieces of information are typically the security questions on most banking apps or online banking services, because you would be giving away your, not only your gender, you'd be giving away your name because you'd be doing it on social media and sharing it. So they'd already have who you are. They would obviously have information from your account probably anyway. They'd know your grandparent, or if it was like your mother's maiden name or something like that. Often they ask you for your first pet's name and your first street you lived in. So there were variations of it, and so it was, somebody pointed out, it'd already gone viral and said, do you realise that's what you're sharing? So the scam is, beware of these things where it asks you these sorts of questions, that you may be sharing information that somebody can use to potentially reset passwords. Because when you try and reset a password, they normally ask you for security information like that. And for some people, they obviously, scammers wouldn't know it unless you give it away. So that's the scam watch. Social media, don't do those things if you can help it, unless, of course, you're going to use different information than the correct stuff. But it led on to the idea of 3 golden rules of this kind of stuff, and I saw somebody give advice about what you should and shouldn't do, and they didn't really quite realise that they had created an ABC of rules to bear in mind, which they didn't call it that, so I'm going to call it that. But they are: assume nothing, believe nothing, and check everything. And I think that can sum up the rules of online engagements. Or if you get an email, you get something on social media, you get a text message, always assume nothing. So don't assume it's from the person who it says it's from, i.e. your bank. Don't believe that whatever the message is true, i.e. your bank's been compromised or you need to reset passwords. And check everything, and that means check independently by going directly, not via the link. And of course, with the TSB scandal that's been unfolding, now if you're not a TSB customer you might not know, but TSB, the bank, decided to change their internet technology, sorry, not internet, but their technology systems in the background. And it was all part of the way they separated from Lloyds. And basically, cut a very long story short, customers have been locked out of their accounts and have seen funds disappear from the screen and all sorts of stuff that have caused untold problems. And some of this has been going on for weeks. And of course, this has opened up the door for scammers, because they know there's lots of people out there who are increasingly frustrated, having lots of technical issues with their bank, so they're sending out phishing emails that I mentioned last week about phishing with a PH, which is whereby they send you an email with a link, click on it, take you to a page that looks like the page you're expecting, i.e. maybe TSB, and then you enter information in there that they can then use to log in on the real site and then take your money. But there's also the other version, which apparently now, according to Action Fraud, is the most popular means of communication by fraudsters, is what they call smishing, which I think is meant to be a combination of SMS, like texting, and phishing. They've overdone it a bit there, but basically via text. So what you can do is, when you get a text message and I text you, Andy, it falls into our chat and it says it's from Damien. And what they can do with banks, you get the same thing, don't you? Your bank, you might get a text message saying something or other about some information. But it is possible for scammers, and people can do this with sites online. You don't have to be that sophisticated. There are sites out there that could enable anybody to do it, where you can mask the number of where you're texting from and replicate one that people are expecting. So they can send you a text message and it will slip very neatly into the chain of text messages and conversation you've had in the past from your bank. So you'll just assume it is from your bank.
Scary stuff.
It is scary stuff. So you have to assume that any text you get isn't necessarily from your bank, and don't click on the links that are necessarily in it, because they tend to put links. So that was the scam watch. To beware of anything that comes out. Assume nothing, believe nothing, and check everything.
I think that ABC rule is really good, and I'm glad you quickly moved on from the story about, your Lord name and what it would be, and actually said why it was a bad thing and what the consequences of giving that information out on social media are, because I was very readily going to give up all my information on this podcast. I was like, oh, that's really funny you should say it, because my name is Lord, and then you suddenly told me why I shouldn't do that. So I'll keep that to myself, but it is a very, very funny name.
Yeah, I sped up, if you listen back, because I thought you were going to do it, and I thought, do I tell him, or do I just allow him to unleash hell on his bank account? Going back on it, do you remember the story of Jeremy Clarkson a few years ago, who said,
with his bank details,
he said about his bank
details,
brilliant. And he said, I don't know why everyone goes on about so bothered about their bank details. You can't do anything with it. You can put money into a bank account. So he had a column, didn't he? That I think at that point was in the Sun or the News of the World. And it was
specifically about the sort code and account number, because he said in this article that obviously the main, on your debit card or credit card, the main number across the middle and the 3 numbers on the back are the key numbers. Who can do anything with a sort code and account number? And he was so confident, wasn't he? He said, here's my number, and he actually printed it in the column, didn't he? Sort code and account number. But he forgot one thing, didn't he? You tell the listener.
He forgot the fact that you can set up direct debits with that information, and he was deluged with charitable
RSPCA, the RSPB,
direct debit.
I think there was like vegetarianism ones as well, because obviously he's a real sort of, a manly sort of meat eating idiot, and people were setting up all sorts of like charitable stuff in his name. It was brilliant.
So that just reminded me of that. Mentioning the Sun, I just want to, before we move on to the next piece, something the Sun did this week, which was really positive. The Sun newspaper, they congratulated themselves on a campaign that they said they won on getting the FCA to look into capping the payments and the amount of debt that people can have on rent to own or doorstep lending. So if there are people who typically on low income who are struggling to get credit, may resort to almost doorstep lenders that are legal, they end up paying very, very high rates of interest, and they can end up borrowing maybe £1,000 but end up paying back 3 or 4 times that. And because of that, probably the demographic they were after, the Sun had that as a bit of a campaign. So well done to them on trying to get that capped, and they did. It seems it's successful. They've patted themselves on the back. The FCA are looking to take action now. But of course, I just want to point out on that, while all that is obviously very good, and the reason they say to get people into incredible amounts of debt with these types of lenders, I would just like to point out to anybody at the Sun and the journalists, and I did point this out to a journalist on Twitter, who was congratulating themselves for a very well-written piece, and they were saving the people who were struggling with credit, that as a newspaper and an entity, they very heavily champion gambling. They have gambling products. You can't even move without some bingo, some bet. All of the products, it's a whole industry in itself. And I think that if you are going to champion people who are getting spiraling into debt, it doesn't quite sit for me. There's something slightly odd about, on one hand, saying, we're championing people on low incomes by not allowing these unscrupulous doorstep lenders to charge them lots of money because they'll get into debt. But on the other hand, why not take out an account with Sky Bet and bet on all these things? Now, I just don't think that personally, and people may disagree with me, but I know that one of the biggest reasons that people can get into debt is because they can gamble. And I think enticing anybody to gamble it's great they've done that, and I applaud them. But I do think they should therefore start a new campaign, and I wish they will do, about limiting the amount of gambling adverts that we see on telly and in front of children, etc. But that would hit their own business. Anyway, I've got off topic, Andy. Let's get back onto what I was going to do. Consistent funds, that's what I was going to do. So, 80/20 Investor, I did a piece about funds that have performed well over the longer term. Now, no fund outperforms all the time. It just doesn't happen because the way the dynamics of the economy, the macro environment with investing. So you'll get 1 minute there'll be an environment that will favour bonds, 1 minute it will favour equities. You get Trump doing all sorts of crazy things that may favour smaller companies that aren't exposed to trade wars, etc. So things constantly change. Managers' styles come in and out of fashion. So a manager may have a particular style of investing, but he'll never outperform all the time. And managers try and claim that they do, but they don't. Typically, if you pick a fund and hold it forever, you will underperform the market generally. Now, 80/20 Investor was all about reviewing your funds. It had a momentum element, but it's got a very strong research element that isn't based around that as well, teaching you how to pick funds. If you review funds and don't buy and hold for the long term necessarily. You can move to what's doing well. So you pick what's doing well in the current environment. So that is what 80/20 is built upon. Now, I'm also aware there are people who do like to have at the core of a portfolio maybe some funds that they don't change that often. So it's like a foundation, a building block. And that's okay. Or you may be in a product that doesn't have a wide range of funds to choose from. So you don't have the 2,000 funds that are out there in the general, in the better SIPs and ISAs to choose from as to invest in. They may have a very, very limited number. So I wanted to try and find out a way in which they could pick a fund that's been consistent and has generally outperformed. That doesn't mean that during periods of time it hasn't underperformed its peers. So I'm going to tell you not the funds, because what I did is I did a piece of research and I whittled the 2,000 funds down to 30. And then I took those 30 and I overlaid a momentum angle, so things that are really working well now, and came up with just 7. And 80/20 investor members can see that research, and that research has really quite blown up on 80/20. People loved it, and it's now probably going to be a regular permanent feature of 80/20 investor due to demand, which is great. I love it when a product develops itself because people want it. But what I'm going to do is I'm not going to give that away, but I'm going to tell people how I did it. And it's kind of, you could go away and do it yourself, and it gives you something to think about when you're doing your own research of funds. So here we go. Now, I started with 2,000 funds. Now, if you're trying to work out as a starting point, what funds that have done well, what does that even mean? Now, the way I worked that out is that I thought, well, if a fund has done well over the last year, that's brilliant. But the last year is only very indicative of an uptrend in equities. In particular, certain sectors have done very well. So that would be technology, for example. It's not indicative of a manager who's managed to do well in the peaks and troughs, the ups and downs of markets. It's just somebody who's done very well in an environment that's favoured them. So we need to look at longer than that. So what I did, I looked at 1 year, 3 year, 5 year, and then I threw in 10 year in there as well. Now, the reason I went as far as 10 years, and I could have done a little bit more, is I wanted to look at what happened at the back end of the financial crisis when the markets plummeted as well. So I wanted a bit of that in there. I didn't want just when markets have been in a general uptrend. I wanted some of the bad stuff in there as well. So I looked at how all those funds and screened them, how they did versus their peer group. So that might be a way of saying peers, people within the same sector. So if you had a UK equity fund, how did it do against its peer group in the 1 year, 3 year, 5 year, 10 year periods? Now, what way could you say is good or bad? Now, one way of doing it is that it's got to be better than average. So you could just see whether it's in the top 2 quartiles, so the top half of its sector over each of those time frames. That shows you that it's consistently outperformed, but it doesn't necessarily tell you the whole story. So I took that screen and I got those ones that had done well over all those periods. I had to do it in all of them. It wasn't either or, all of them. I then looked at what happened in each of the last 5 years. So in particular, the 5 years we've had some ups and downs. We've had Brexit, which caused a wobble in the market. We've had the Chinese devaluation of their currency, which caused an almighty wobble when everybody thought that the Chinese economy was slowing down. And we've obviously had a wobble even this year. So I wanted to look at how they've done in each of those years. So if you've been consistent over the long term, it's also about trying to work out how you've done over each stage. So if you think about a race, it's about someone who's done consistently well over every leg of a relay rather than just the end result. So that got me down to even fewer. And again, on that one where I was looking at each year, I was looking, they had to be above average, because just being above average is a 50-50 chance, but to consistently do it, it's like consistently tossing tails, the odds of it keep doing it and keep coming up tails get smaller and smaller the more you do it. Bear that in mind. I then wanted to introduce an element of skill into the screening process. What measures of skill can you have for a fund manager? So I settled on 3. Now you could choose others. One of them is alpha. Now it's just a statistic that's quoted quite freely on fact sheets or things like Morningstar, and it's a measure of the excess return over the fund's benchmark. So it's not just now looking at what they did against their peers, so it's looking against what the manager is saying the benchmark it's going to beat. So give you an example, a fund could be in the same sector, so it could be a UK equity fund, but the benchmark one fund might be the FTSE 100, the other might have the FTSE All Share. So there could be different benchmarks. So if a fund is going to do what it says on the label, had the manager managed to do that, the excess return over what you expected from the benchmark itself, the higher that number, the better. The next one I looked at was Sharpe ratio. Now, Sharpe ratio, and that's sharp with an E on the end, measures the extra return for the extra risk they took. So what you don't want is you don't want a fund. A manager may make loads of money, but he may be taking loads more risk because he's being incredibly reckless. You don't want reckless managers. It's a bit like if you're driving cars. You don't want a reckless driver in a Formula 1 Grand Prix. Eventually they'll crash out just because they did a really good first lap, but they're driving like a nutter, not using their brakes. They're not going to get past the third. And that's the kind of what Sharpe ratios do in fund management. They show you people who are taking risks, calculated risk, and they're getting the return. So I like that measure. It's one of my favoured one. I don't know if that makes me a saddo that I have a favourite fund statistic. It's one of my favoured ones. I like it. So that the higher that is, the better. And the other one I wanted was to have something that showed how funds had fallen. So we want to look on the downside, not just the upside. So I looked at the maximum weekly falls over the last 3 to 5 years. So what was the biggest amount it fell at any one point? So you get an idea of like, yeah, do you know when it really hit the fan, this one fell at most 4%. It gives you a steer. So what I did then is after I'd done the original screens based around performance, I then had this skill element looking for the ones with the highest alphas and Sharpe ratios and the lowest max fall returns. You can create your own levels you want, but when you get down to that number of funds, you can very quickly see what is good, what is bad relative to each other, and you can form your own benchmarks. And you could on that last one maybe use some other screen. If you can't get the max weekly fall, you might use something like maybe volatility, which is widely quoted. Slightly different measure, but it's the ups and downs, the wobbliness of the returns. So taking that all together, that got me 30 funds, and then you overlaid the momentum angle, which is really looking more at what's been going on more recently, then that gave me the 7. So what I've done is just given people a recipe really of how I would approach it. And one of the things I try and teach people is the most important thing is the analytical element of trying to work out if there was even an answer. Because I didn't even know if anything would come out the other end when I did this. And sometimes when I do research, nothing does, and I've wasted a day doing it. And unfortunately, I won't get any credit for that. But that's just the way it works. You try and break it once you've got the answer. And if you can't break it anymore, then it normally means that you've come up with something pretty good. So follow that general recipe. And what will come out, you'll have funds that have not only performed well over the long term, they've performed well over the near term, but over all those periods, they've done it consistently, which starts to suggest it's not just luck. Then with the skill element, you can then almost prove that it's not just luck. And as a throwaway one, measure it against maybe some of the ETFs that are passives out there that you might come across. So just to see how they measure up, because they're good measures of the market. So there you go, Andy. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insight, you get market commentaries, monthly commentaries and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, Damien, so we're going to finish off with talking about fuels, and specifically dual fuels. We've always been led to believe that it's good to double up and have it through the same provider, but you've got some insight that suggests that might not be the case.
Well, Energy Helpline, who are effectively do comparisons on all this stuff, have suggested that it could be a good idea and you might be able to save even more money by separating your gas and electricity bill and having it with different providers. Now, they've said that the financial incentive offered by the big six, so the major companies, the people like British Gas, that provide gas and electricity, has been removed. So therefore there isn't really any benefit in doing it anymore, and it's only the smaller players who tend to still offer an actual incentive or reduction if you end up having a dual fuel account. So some of the names, Utility Warehouse, I'm not giving them free advertising, it's just so you can understand what they mean by smaller companies. Now most people won't have even heard of them. So what you need to do is check if it is cheaper to split your energy bills. Don't always assume it is necessarily dual fuel, which is something I hadn't really realised that had been removed. So there you go, that's one of those things you live and learn. It all goes down one way where we all learn that it's better to keep them together, and then the companies decide, do you know what, let's all collude together and not offer the incentive, then we're keeping more of the money, which is probably what happened, what I think would have happened anyway. So it may be cheaper to split, but there is a slight downside, because if you lock yourself into a gas deal and you lock yourself into an electricity deal, they may have different lock-in periods, and that might become a bit tricky to juggle when you're trying to therefore switch at a later date, trying to tie those things up. So bear that in mind. You might want to try and get them at similar times, but normally, even when you're coming to the end of a deal, about 49 days I think it is beforehand, you're allowed to start moving around and switching. So there are things you can do, so check the T's and C's of a deal that you sign up to, but it's something to bear in mind. And as a final comment that I didn't realise, again, like I said, you live and learn on some things. I learnt on the big six and their dual fuel non-discount, but I thought that everybody knew that you could get no claims discounts on home insurance. And apparently I was reading something this week that a secret tip by one of the newspapers to get cheaper home insurance is to have a no claims discount and use a no claims discount, and that most consumers didn't realise that you could have no claims discounts on home insurance and thought it was only on car insurance. Now, I didn't realise that. I thought that was a given that people do that. But if you didn't, then you are clearly in the majority that didn't apparently know that you can have no claims discount on home insurance. So if you are, bear that in mind, and if you are switching around, then bear that in mind as well, because you can look at your new provider if they're going to give you a discount for having no claims, and therefore you need the relevant paperwork from your old insurer. We're done.
Very good. And just another tip from me, don't do what I do, which is let your home insurance and your car insurance auto-renew. Yeah, I let that happen on both this year, and I'm ruining that happening. I don't know why I let it happen every year on year.
It's because you're normal, Andy. You're just like everybody else. You're a man of the people.
Yeah, but then on my energy bills, I went and actually did something that you suggested on the podcast and use a company called Flipper, and I've never looked back. I've saved over £600 since I've done that. So why didn't I just reap your advice and do it the proper way on the other stuff? I will do it. Right, we're done.
We're done. So, usual stuff. Please contact me with any ideas, questions, Damien at moneytothemasses.com, Twitter, money2themasses with the number 2, and do leave us a review because they help us on iTunes get up the charts, and we just like to read them out.
Lovely, you've done my bit at the end there, which means that all is left to say is see you next time.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.